And I'm not a big technical guy, man. I'm very good at it, but it's just a tool. It isn't, it isn't perfect. I think we could see gold under 2,000. I think it's more for psychological reasons that the mainstream press can say, "Oh, see, gold's under 2,000." No, 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 no. I don't see it going down a lot below that level. I just think it's going to be a good year for both metals. There aren't a lot of places to go. Real estate market, commercial side looks horrible. Even the residential side doesn't look that strong. Rents are frozen in some areas, but everybody's got to have a place to live. The equity market's still overvalued.
JP Morgan forecasts that the Fed cutting cycle and falling US real yields are expected to push gold prices to new nominal highs in the middle of 2024, reaching an average of $2,175 by the fourth quarter. In the same vein, silver prices will likely follow gold, averaging around $30 per ounce in the fourth quarter. Renowned analyst David Morgan from the Morgan Report foresees a brief dip in gold due to psychological factors, but remains optimistic about gold and silver. He deems real estate and the equity market risky, making precious metals the safest investment. Gold prices are posting decent gains, and silver is slightly up in early US trading Friday. A bit more safe haven demand is featured in gold heading into the weekend amid still heightened tensions in the Middle East. A weaker US dollar index today is also a supportive outside market element for the metals markets. David envisions an inevitable shift to a new monetary system, raising crucial questions about debt resolution. According to the Congressional Budget Office, rising interest rates pose a significant concern, leading to increased borrowing costs for the federal government. As a matter of fact, interest payments on the national debt are projected to be the fastest growing part of the federal budget over the next 3 decades. Due to increasing interest rates, debt payment expenses are expected to triple from nearly $475 billion in fiscal 2022 to a stunning $1.4 trillion in 2032. However, David recommends saving real money for those who understand the situation. Gold and silver have significantly increased over the last 23 years, with gold outperforming silver. Gold has been a better performer than silver in the past few years. The metals have grown 13% and 3% respectively since the beginning of 2023. The gold-silver ratio was above 125 during the pandemic and has dropped to 83 to 84 so far. However, silver is considered a more volatile financial instrument. We will present clips from David Morgan's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
The reason that I've devoted my life to this is because it's mathematically impossible for a fiat debt-based monetary system not to fail. And of course, a lot of people go to the extreme and say, well, that means the dollar's worth zero. I don't think we're ever going to get a zero worth dollar, but its trend is definitely there. The 1913 dollar's worth about 2 cents. But no, the end game, I don't know. What I do know is what they want, and we talk about this almost every show, and that is they want to implement a new system. And then how do you get to the new system? Well, the first thing is the narrative. What story do you tell everybody so it's not the bank's fault and everybody wants to keep their confidence in the banking system? So you have to come up with a good story, which could be like a cyber attack, for example. And then you tag it with whatever, enemy de jure there is. The Ministry of Truth comes out and says, oh, it's the Russians. Well, wait a minute, we used the Russians too many times. It was the Chinese, or it was a rogue state in the Middle East, whatever. I mean, who knows what they'll come up with? Could be a false flag, meaning that it is a true cyber attack, but it isn't actually done by anybody that's named and pointed out or made the victim. It could be someone, I hate to say it, but someone within the confines of the banking structure, or let's say the system. This is really important. No, there's no way out of this mess. Something's got to give. And we just don't know what that looks like. I mean, do all the debts that exist go away because they can't find them on the computer anymore? Do just certain debts go away, like government debt goes away, but your household debt for your mortgage and your car loan stay in place? Your school loan still stays in place? It's a very precarious situation. In a debt jubilee, all debts are forgiven. I mean, I think most people that learn what's really going on should save in real money. And if you do it on a longer term basis, you'll come out ahead. In other words, if you dollar cost average over the last 20, 23 years from the beginning of this bull market, gold was at 252, now it's at 2000. Silver is under 5, and now it's at 23. So they're both up. So gold has outperformed silver at this point in time. So I think that's the approach. And then, things get rearranged. It's hard to say what the authorities will do as far as payment goes. So, for example, my favorite gold company was $30 when gold was at 2,000 12 years ago. Now that stock's at 100. So it's up 300 something percent, and gold is the same price. So if you put your 10,000 gold in the year 2011 September, it's worth 2,000 now. But if you put it into my top pick for a gold company, it'd be worth 6,000. And then I looked at my favorite silver pick, and it did about the same, it doubled. And that is really remarkable when you think of this silver company that's doubled from the time that silver was at $50, because we're less than half of that now, and yet the price has doubled. So if you bought silver at the top of the market at 50, right now you've lost 50%. But if you bought that stock at the top of the market, right now that $1,000 investments were 2,000. So if you know what you're doing, picking, the miners or the resource sector, you can beat the market. And I just want to make that clear. I mean, I know I'm kind of touting my own word, but it's the truth, and it works. And that's why I think you should have a balance between physical metal and the equity side if you know what you're doing. And those numbers are facts. They're not made up. They're not wishful thinking. The problem is it's almost too simple. And once people learn that from me, say, oh, it can't be that easy. So they're always looking for that mother lode, right? That little stock that's 12 cents, it's going to go to $120, and they're going to buy their own island, And that happens, but not very often.
During the interview, David Morgan delved into the concern of unrealized losses in the banking system, particularly related to long-term securities affected by rising interest rates. Banks in the United States had $684 billion of unrealized losses on their securities investments at the end of September, a 22% increase on the preceding quarter, according to a report from the Federal Deposit Insurance Corp published on November 29th. Furthermore, David stated the contradiction between significant unrealized losses and seemingly stable bank net income. He also highlighted the intricacies of interest rates in a fractional reserve system, where leverage amplifies profits and losses. 4 U.S. banks warned of lower interest income for this year on Friday, capping a week of dour commentary from the industry that has been under pressure from high deposit costs. After more than a year of booking strong profits on the back of the high interest they were able to charge on loans, banks are contending with a string of challenges heading into 2024, including weaker loan growth and potentially tougher capital rules. Let's get back to the interview.
Well, on the unrealized losses, the key word, of course, is unrealized. So that means that if these banks had to cash out their long-dated securities, you see that's in the dark blue or black, depending on your screen. And in some cases, it looks like it's almost 50% or close to it of the bank's total holdings. So that's very, very concerning for the whole banking system, because they're all interconnected. And yet the other chart shows that their net income is actually pretty stable, and it doesn't show much real loss. So the way you reconcile it is this. The reason there's the unrealized losses, we'll just go over the basics here, is because interest rates have been increased. So those 30-year treasuries, those long-dated bonds, even a 10-year note, have decreased in value. So if you had to sell them now, you'd be selling them at a loss, and you can see the losses are substantial. And that has been done. And yet you get a net income, which is like a real head scratcher. The reason it is the way it is that the Federal Reserve said, okay, here's what we'll do. We will let you put up your securities, whatever they are, whatever the maturity is, and we'll loan you the face value. So you don't have to take a loss immediately. You're getting a loan. So if you had a house that was worth $100,000 and had a big market crash, and the house is now worth 70,000. And your banker was really, helpful to you. And he said, what I'll do, Elijah, is I'm going to give you the old value of 2 years ago. I'll give you the 100,000, but it's only for 1 year. And 1 year from now, you've got to pay me back. So that's how you can have all this net income, is that because the banking system has been drained of liquidity as far as ready cash. Cash deposits have all moved into money market funds, which means the banks are even more insolvent, yet their net income looks good. Well, why is that? Because they get to play the spread. So you get to get all this, I'll call it free funny money, and you borrow it at X and you loan it at a point higher, and you're making that spread in your direction. So of course your income looks good temporarily. Now, when the call comes, literally it's called a call loan, and they call and say, Elijah, the year's up, worth 100 grand. These banks, will they pay it? Can they pay it? Or whatever. The other thing that most people don't ever talk about in a fractional reserve system is how really convoluted it is on interest rates. You don't really ever delve into this part of the equation very often, or at least I haven't heard it very often. So if I only have to have a 1 to 10 ratio, so if you deposit $100, all I have to put on account is 10 ready cash, and I get the other 90% to loan. Instead of getting 1% on the $100, I've got 1% on the 9, but it's loaned out again and again and again. So that 1% goes to my bank, and then I send it to another bank, and they get 1% on the $80, and then the next bank gets it on. So you're really getting like a 10% yield on a 1%, if that's the going rate, let's say, loan, because you've spread that money out 10 times. Of course, it's decreased slightly all the way down from, you have to hold $10, so you loan 90, so 90, you have to keep 90, have 81, and on and on. You do the arithmetic. But I don't think people think about those multiples, because the system is so leveraged or geared, as the Brits say, that it goes both directions. And that's why those bond unrealized losses are so huge. So,
in times of banking troubles and escalating debt, these precious metals are sought after for their intrinsic value and ability to retain purchasing power. How do you perceive the impact of the banking system and increasing debt on the safety of gold and silver as investment options? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.